My name is Madison Vaughn, and today I'll be walking you through my financial simulation for capital budgeting. The purpose of capital budgeting is to acquire long-term assets. This is critical for a company's long-term success. When looking at the front screen of this simulation, you see that as of 2014, my company received an APV of 542.2. My company received this APV through my investment decisions that you can see over here in project updates. Also on the screen, you see a financial snapshot and divisional reports of my company. As of 2009, our revenue was 245.75. Through my investments, I was able to make this into 388.74. The operating income for 2009 was 22.6, while currently it is 45.53. The net income was 13.56 in 2009, and currently it is 27.32. In divisional reports, you can see cash flow by division. Currently, licensing has the highest cash flow, followed by retail and then production. In 2009, licensing also had the highest, but production was the second highest and retail was the lowest. You can also look at the revenues by division. You can see that retail has the highest revenue per division at 261.64. Licensing is the lowest at 79.63, and production is the second highest at 189.88. Next, you can look at the operational profit by division. Licensing is the highest at 26.82, production is at 12.82, and retail is at 5.9. You can also look at the total assets for division. Production has the highest amount of assets at 117.48. Then retail has the second highest at 97.71. Finally, licensing has 45.72. Next, it is important to look at the income sheet and the income statement and the balance statement. You see that the net income for 2014 is 27.32. In 2009, the income was 13.56. Next, you look at the total assets and total liabilities and stockholders' equity. Total net assets is 260.92, as well as the total liabilities and stockholders' equity. In 2009, the total net assets and stockholders or liability and stockholders' equity was 165.52. Both of these are expected to increase through 2024. Next, we will look at the cash flow statement to see that the total net income plus depreciation in 2014 is 42.54. This is expected to grow. The cash flow statement shows the cash flows from operations, investments, and financing. The total ending balance cash flow for 2014 is 12.39, which is also expected to grow through 2024. In 2009, the ending cash balance was only at 6.70. So through my simulation, I have doubled that number. We also see that a great amount of cash flows comes from operations, which is a sign that the company is performing the way it should be. This is also expected to increase. Cash flows from financing and investing are also negative. This will continue throughout the year 2024. My strategy is to focus on increasing revenues, mostly from retail and licensing projects, but also from a few production projects. From here, we will go ahead and see my investments that I chose. In 2009, I chose to invest in a toddler doll accessory line, a Match My Doll clothing line, and a new doll film and DVD. I chose to invest in the new doll film and DVD because its payback period was only a little over a year. Then its net present value was at 9.37, which means that the benefits outweigh the costs because the net present value only has to be equal to or greater than 0 for it to be an acceptable project. The internal rate of return was at 238.61, which is promising because the higher the IRR, the better, and the more acceptable the project is. The profitability index was at 8.93, which is also acceptable because the profitability index only has to be equal to or greater than 1 for the project to be acceptable. As you can see, the video was released on schedule and the marketing campaign was very successful, and DVD sales exceeded those of previous films. I chose to invest in the Match My Doll clothing line because the internal rate of return was 20.69%, which is an acceptable rate, while the net present value was 6.48 and the profitability index was 1.41. I figured that this project had great potential. And as you can see, the clothing line outperformed expectations because of A Celebrity's Daughter. Its gross margin was also higher than expected due to the lower than anticipated cost of raw materials. Finally, in 2009, I invested in the toddler doll accessory line. I invested in this because the net present value was at 7.15, which shows, again, that the benefits outweigh the costs. The internal rate of return was at 25.69, while the profitability index was at 3.34. And as you can see, this project performed in line with expectations regarding both sales and costs. In 2010, I invested in the Dolls of the World initiative and the Tween book series. The Tween book series had an internal rate of return of 43.57, which is highly desirable. The net present value was sitting at 6.14, which is also a good number. The profitability index was at 13.64, and the payback period was 5.24 years. It seemed like a good investment to me, and it ended up being a successful project as two of the titles in the series ended up on a talk show. The Doll of the World's initiative, I chose to do this project because it had a payback period of, although it had a payback period of a little over 9 years, the net present value was 6.32 and the internal rate of return was at 19.9%, which are both acceptable. The profitability index was 1.51, which is also acceptable because it is greater than 1. In 2011, I invested in the doll video game, the acquisition of children's magazine, the expansion of mail order catalog business to Asia, the retail store expansion in Northeast, and the Match My Doll clothing line. The doll video game had a payback period of a little over 2 years, a profitability index of 8.73, a net present value of 1.06, which are all acceptable. The internal rate of return of the project was 115.9, which means that the annual percentage rate of return was promising. This game shaped up to be a good investment. Initially, it says initial market response suggests that this project will underperform, but it was still expected to contribute positively to the company. I chose to invest in children's magazine because the profitability index was 1.15, the net present value was 28.96, and the internal rate of return was 19.52, which are all acceptable. This ended up being a decent investment because the magazine's paid subscribers had been held up better than expected, despite the online competition. Therefore, financial performance is consequently somewhat stronger than expected. For the mail order catalog,